big week this week. It was a really eventful week for both investors and for financial markets. The much anticipated Federal Open Market Committee meeting on Tuesday and Wednesday resulted in the Fed preparing markets for a move in March. Now, nobody expected the Federal Reserve on this meeting last week to raise interest rates. I mean, that would have been, it would rock markets. Because the Fed usually prepares markets for these kind of interest rate things, just like they did in this meeting. They made it pretty well known that they're probably going to raise interest rates 1/4 point in March. Now, the markets can digest it, so when they do it in March, it's no surprise. The markets have adjusted to it. But there's other things that the Fed said that were very interesting regarding monetary policy. And they said that they're going to be a little bit more aggressive in dealing with inflation. They're behind the curve. They let it get out of control. They said it was transitory. They kept interest rates at zero forever. They've been printing $120 billion a month. They've been doing quantitative easing. And they started slowing that down, I think, in December. They're down to $60 billion a month now, so they cut it in half. It's going to be $30 billion in February. And it's going to be zero in March. Now, is that something that financial markets are concerned with? Absolutely. The reason why the stock market had hit such levels was not because of corporate earnings and the economy was so good and everybody was enjoying employment and making tons of money. That wasn't the reason. The reason was the Fed had monetary policy that was, in effect, a stimulant to markets. When you keep interest rates at zero and you print money to the tune of $120 billion per month, that money's got to find a home somewhere. And it found a home in the stock market. At least one part of it. Some found a home in real estate, in cryptocurrencies, in commodities. So what happens when you reverse that process? And that's the real concern now. It's not that they're going to stop the quantitative easing and take that fresh money out of the system. That alone is going to be negative for the markets. But if they start reversing it, and they made statements to that effect, that they're going to do quantitative tightening or reduce their balance sheet, it's the same thing, then that's a big deal. That's the opposite of injecting cocaine into the market. When you pull that stimulus away, that's one thing. But then when you reverse it and you start selling securities and pulling money out of the system, well, it's almost a guaranteed lower stock market. Guaranteed. Because if you think about, just the facts, the reason why the market went up was because they were doing this. If they do the opposite, what'll happen? Well, the market's not going to still go up when the Fed's pulling the punch bowl away. The Fed indicated there may be as much as 4 or 5 interest rate increases this year. Now, granted, when they raise interest rates, it's nothing significant. It's 1/4 point usually per meeting. So 4 increases of 1/4 point will only get us to 1% on the federal funds rate, which is going to do nothing to fight inflation. But what it will do is rattle the stock market and the real estate market and everything else. And we've seen an increase in interest rates in the bond market since all this talk of tapering and then raising interest rates. I mean, the 10-year bond has hit as high as 1.90% in the last couple of weeks. It's currently 1.77%. It went down a little bit, which I think is calling the Fed's bluff. I think the bond market doesn't believe it. I don't think the Treasury bond market believes they're going to raise interest rates 1%, 1.25% this year. Interest rates would be a lot higher on the 10-year bond. But if they raise interest rates, they stop buying Treasury bonds, they start selling Treasury bonds and quantitative tightening, it's going to have significant ramifications for not only the stock market, but the real estate market, the bond market, the economy. And the question is, how much pain is the Fed willing to take before they chronicle and start going back the other way again? And the Fed has done everything they can to protect the stock market, and everything they've done. But now they've created a house of cards, and are they going to be the one to kick it over? And there's a big risk now, and we're starting to see it in the volatility that we're seeing in the markets that we've seen so far this year. We have one more day in January tomorrow, then we'll have the final numbers for January. But it has been one of the worst starts to a year that we've ever seen in the stock market. The Dow's down 4.5% for the year. The S&P's down 7% for January, and worse hit yet is the Nasdaq, which is down 12% for the month. And you got to realize the Nasdaq was the high flyer. That was the Netflix and the Facebooks, and the Apples and the Googles and the Amazons. Well, the Nasdaq's getting hit harder than any index right now, and that would make sense. The ones that go up the most are the ones that are going to fall the most. Now, for the week, if you experience the market on a minute-to-minute basis like I do and other financial advisors do, you got financial TV on all day and you're watching almost every tick of the market, this was one roller coaster of a week. And when I found out that for the week the markets were actually up or unchanged, I wouldn't have believed it. Because earlier in the week we were having some pretty substantial declines. And when the Fed announced, they have their meeting, they put out a statement. The markets were up. They kind of liked it. They were up 400%. 400 points the Dow was, 450. And I said to my partner, I said, Mart, I said, looks like the market's pretty sanguine over this. And then about a half hour later, Jerome Powell, the Federal Reserve Chairman, did his question and answer press conference and spooked the markets. He said basically inflation is probably higher than the 7% being reported, and he indicated that they may be more aggressive in their reducing their balance sheet and raising interest rates to combat inflation. And the market didn't like it. So we had a big reversal from going up 450. I think the market closed down 300 or something like that, and you had a 700-point reversal. And that's the thing about the stock market nowadays. The market could be up 250. I go to the bathroom and come back, it's down 150. I mean, the volatility we're seeing is just something we haven't seen in some time. And volatility up and down is not the sign of a healthy equity market. It's a sign of a sick one that doesn't know direction, that's unsure of what's going on. You got your bottom fishers who buy the dip because it always worked in the past, but doesn't seem to be working now. You see the market up all morning only to falter in the afternoon and close at the lows of the day. That is not what you want to see in the stock market. So it was a good Friday for the markets. Late in the afternoon, we had a big surge in the Dow and the S&P and the Nasdaq. The Dow was up 565 points on Friday after a very volatile week, up 1.7% for the day. And that took the Dow from a negative week to up 1.3% for the week. Still down 4.4% for the month. The S&P 500 closed up 105 points, the high of the day, up 2.4%. Rescuing a negative week, up 0.8% for the week, down 7% for the month of January. The Nasdaq closed up 418 points, 3.1%, and ended the week unchanged. But I'm saying, if you were a trader and you watched the markets all day, every day last week, it was so volatile to see at the end of the week that the Dow was up 1.3, the Nasdaq up a fraction of a percent, and the Nasdaq was unchanged. It feels impossible, and not for the late afternoon surge in the stock market on Friday. We would have saw another negative week in the markets. So we touched the correction area, down 10%. The market was way overdue for a correction. The correction did hit, and we'll see where we go from there. Does a correction become a bear market? Well, a bear market would be down 20% off the highs. Well, we're only down less than 10 now with the rebound on Friday. But the market decline is not over from a short-term point of view and from a long-term point of view. If the Fed is going to follow through with what they're saying and they're going to battle inflation with the tools they have available, higher interest rates, the end of QE, the beginning of QT, quantitative tightening, where they're selling securities into the market. The question is, what happens to interest rates? If the Fed was the buyer of last resort of Treasury debt, and they're not there to buy, they're actually selling and competing with the U.S., where would interest rates have to go to attract capital? That's a good question. But there's a crisis in the stock market right now, and not everybody knows it yet. I think when people see their statements for January and see the decline in their portfolios, and just realize the indexes have fared much better than individual stocks have done. I mean, almost half the stocks on the NASDAQ are down 40% from their highs. I mean, that's a severe bear market. And I own a lot of small companies that trade on the NASDAQ. They got battered. Good companies. In the last few months, down 40, 50%. So the smaller companies are even being sold off more than the big ones. So we got to keep an eye on the market. The market is in trouble right now. And this is not a market that I'd want to be overly exposed to. And the thing is, we never know what, I don't have no idea what tomorrow is going to bring. I could wake up in the morning, turn on my computer, and the Dow could be down 500 points. It could be up 500 points. I don't really know. It's such an emotional market right now. So big news this week. People were waiting for the Fed to come about. And why is interest rate such a negative thing? Why is it? Because there's so much debt in the system. And if you increase interest rates, debt servicing requirements of companies and anybody with debt, they go up, which means there's less capital available for expanding your company or to spend on consumer goods if you're a family. Housing slows. You got to realize people buy payments, they don't buy houses. What do I mean by that? How much can I afford? That's how people go and look for a home. Okay, I could afford X number of dollars a month at a current interest rate. How much can I borrow? And that determines how much house you could buy. Well, as interest rates go up, mortgage rates go up, you do that calculation, you could afford less house. So you're not going to buy the $400,000 house. Now you're looking for the $325,000 house. So demand for the $400,000 houses decline, prices decline as well. Higher borrowing costs. Corporations have been borrowing money like mad over the last 10 years because interest rates were so favorable. A lot of that debt's maturing right now. They have to refinance it. They refinance debt at higher interest rates. Their borrowing costs are going to lead to lower profit margins, and their stock has to come down to adjust for that. The massive derivatives that are out there will be negatively impacted in ways that none of us even know. They're so opaque, but there's trillions and trillions and trillions of dollars worth of derivatives that will be adversely affected by rising interest rates. Then you have variable interest rates on credit cards, home equity lines of credit. That will reduce consumption by the consumer. And if we see more defaults, we see rising defaults on debt service, well, that's going to negatively affect the banks. A lot of support in the market has been from share buybacks, where companies have issued bonds, cheap debt, and used that proceeds to buy their stock back and make their stock price go up. Well, if there's no more cheap debt that they could borrow, that major buyer in the market will no longer be there. And we're going to see the deficit go up because now interest rates on $30 trillion of debt are going to start to rise. So there's a lot of negative things. When you have a rising interest rate environment, it's very negative for the economy. It's very negative for families and consumers who have a lot of debt. It's negative for corporations who have a lot of debt. It's negative for governments who have a lot of debt. And the world has never been more indebted than it is now. So let's see how the markets react. And again, the Fed is not there for the people. The Fed is owned by, created by the banks and the elites and the rich. And they've always taken care of their own. And I think they will. Now, the market, Bloomberg did an analysis, and the market has never plunged 10% this fast to start a year. Never. And that's saying something. It's going back 90 years of records. The S&P 500 dropped 11%, heading into correction territory in the first 16 trading days of 2022. Its worst ever start to a year, according to Bloomberg data that goes back over 9 decades. And it looks like a lot of technical areas have been broken, and we have further to go to the downside. And I'll tell you, like I've been telling you for some time now, if you're overexposed to the stock market and you're not sure, get advice and lower that risk. There's no money to be made in the stock market in a rising interest rate environment. There is none, historically. There's a good chance of significant losses. All right, let's take a break. 732-505-1160 is our call number if you want to be part of our program. My name is Lou Scatigna. You're listening to Financial Physician. Don't go away.